very good evening to all of you. A warm welcome from all of us at Grand Thornton Bharat to this webinar. First of all, thank you very much to our distinguished speakers, participants, and members of the media today. Well, I'm delighted to this conversation series around today's theme, which is around overseas listing for Indian corporates, the big opportunity. As India moves to a $5 trillion economy, global capital markets and global investors become a key part of any corporate strategy. And mechanism of raising capital and of course accessing deep pools of capital, efficient pools of capital, and truly unlocking value for all stakeholders. And finally, really uplifting the reputation and the brand of corporate. As all of you are aware of, raising capital in overseas markets has been discussion for quite some time. In fact, in Grand Thornton, we did this theme around overseas listings in 2016, 4 years back. In May 2020, the government of India has announced measures to help companies raise funds, including allowing Indian companies to directly list in overseas markets. It is also expected that a mandatory requirement to have such securities listed on the Indian stock exchanges may be done away with. That, in my view, is a very different change to the previous regime and to the previous regulations. Of course, there are changes got to be made to the current regulatory frameworks, but this change, in my view, will improve the overall competitiveness of Indian companies. And hence, we from Grand Thornton believe this is a massive opportunity. On this backdrop, we put together this conversation series. And as you can see, with leading global experts, people joined from the US, from UK, from Dubai, from Singapore, who have massive experience in helping and actually doing transactions and taking corporates to capital markets in the overseas global arena. We will continue this conversation series in the coming months, where we will discuss the how in terms of the process, the preparation, and the planning of what corporates should be doing to really list overseas. But today, we would be focusing on why. Why is it important that this change in regulation and this opportunity is critical for Indian corporates to truly reflect on and leverage this? I hope that you will find the discussions valuable to you. There is a chat box in which you can post your questions and even your comments. The moderators will pick up the questions at the end during the Q&A session, and we would definitely like to address as much as possible. Well, before I hand it over to the speakers, there's one thought, one story I've always remembered in kind of the experience of the last 2 decades in consulting and helping companies, is basically a story about Narayan Murthy. Narayan Murthy, obviously, as all of you know, 1998 is where Infosys went to the US to list in NASDAQ. And Narayan Murthy said that sitting on a high stool at NASDAQ in New York, in front of scorching lights of TV cameras and media, the world was definitely different. But however, I remembered the words of Neil Armstrong. Well, for Narayan Murthy, he said that this is possibly a small step for a company, for an Indian company, but for India, this really takes us to the global stage. And of course, Neil Armstrong said, small step for a man, but a giant leap for mankind. So with that stage, hopefully in front of all of us for Indian corporates and Indian investors, I now would like to invite Vishesh C. Chandyok, our very own CEO of Grand Thornton Bharat, to give the opening remarks for this session. Vishesh, of course, has significant experience in the last 2 decades of helping many corporates, but specifically a lot of Indian corporates in listing overseas, especially in the UK markets. So warm welcome, Vishesh, and over to you.
Thank you very much, Raja. It's a pleasure to be here with all of you. I've had the experience of dealing with this subject for a number of years, and it's a pleasure to be able to share some of my experiences in 5-6 minutes. So as I was saying, I've had about 30 years of experience, and over those 30 years, I've been seeing what changed in the space of overseas listings, and I can sum it up that the space of overseas listings from India have seen their ups and have seen their downs. I remember, back in 1993, the first box you can see up there is when the first phase of overseas listings opened under that FCCB and ordinary shares through DR mechanism, where I had the experience of working on, at that time, a very reputable company, Vanbaxi Laboratories, when they raised a GDR in Luxembourg. And it was that spate of GDRs in Luxembourg at that time, just after liberalization of our economy. If you see below that, the first green box, in about 2003-4, we started talking a lot about the opportunity for Indian companies to consider raising capital overseas. As you remember, in those days, the economy it was really buoyant. A lot of new age companies were coming up. Private equity was funding that growth, but how does private equity get an exit? And we built up a database of over 200 prospects, really dynamic growth companies who would have liked to raise capital overseas at that time, between 2003 and 4, when we were talking about that subject, largely on AIM, but also LSE, as well as US market, some Singapore. But then suddenly in 2005, that scheme was amended, which closed the option of directly listing an Indian company's shares overseas without first listing in India. That didn't stop people. If you see the second purple box on the top, there basically what people did was flip the structure. So instead of remaining an Indian company, you set up an overseas company and sold the shares of your Indian company to that overseas company, and then listed that overseas. Indian companies become global companies and list that global company overseas. That became more complex over the years ahead because of change in valuation norms in India, and just the complexity, tax consequence of doing that sort of, transfer. That didn't stop everything. There was some listings thereafter. 2012, there was again the hope that many of India's infrastructure assets will see listings of REITs. Some did list in Singapore at that time. In 2013, the last purple box on the right, there was a conditional opening again, but those conditions were just so many that it wasn't really something that encouraged too many companies. And really in 2020, where we stand, as Raja also mentioned, is when the Companies Act was amended, and as part of the recent Atmanirbhar Bharat announcements, perhaps an upside of this terrible COVID tragedy, the government has shown some serious momentum behind allowing direct listing of Indian companies overseas once again. So on the back of that, the idea today was to pull together a series of terrific experts representing stock exchanges, depositories, investment bankers, accounting experts, to talk about the why of overseas listing, why consider an overseas listing, as we truly believe we're sitting at the at the cusp of that finally happening again, and us going back to pretty much that 93 era where you will have the ability to list directly overseas. I'm not going to go into the details of the number of regulatory shifts that have happened over that time that have made overseas listing complex. But one example of that is just this example from October 2019 SEBI circular, which basically stopped not only Indian residents from investing in DRs, but also non-resident Indians. Of course, now where we are is this last step, and that's what I just touched on. The MCA is drafting, I understand, a report that will hopefully clarify all these impediments, and we have the experts to talk about what some of those impediments are. And we'll probably touch on some of those things in the future. Today, the discussion will focus on the why more than anything else. Just a couple more slides, some facts for guests who joined us on this Friday evening. So how many companies from India are currently listed on major overseas markets? And if you see the numbers there, with more than 5,000 companies listed in India, these numbers appear small, and they'll never be the same, but 18 on LSE, 3 of which were on the smaller board of LSE, AIM, 3 on NASDAQ, 12 on NYSE, and the sort of capital that was raised on those exchanges, again, you can see below that. So about 284 billion on LSE versus 6 billion on AIM. Of course, AIM was a market for smaller listings up to 500 million usually, but attracted a large number, and we believe would have attracted many more. Of course, attracted some who should never have listed from, if you see the sectors up there, real estate, power, tech, services, funds, the companies who listed there, some of them should never have listed, but some also, what happened with some of those sectors in India in the period since December 12, which is when that number was 23. I think that number's gone down to about 8 currently on AIM. And of course, NASDAQ, the 3 technology companies. We have Keshav following me, who will, of course, talk about NASDAQ and NYSE. And of course, we have Bob from NASDAQ, who will talk about the opportunity there later. I have to make the obligatory China versus India comparison. I talked about the 5,000 plus companies listed in India. I talked about the 69, 70 odd companies who pursued overseas listings. If you compare that number, with the number in China, particularly on the US markets, if you see, that number 64 plus 80, so over 144 companies, nearly 200 at some stage were listed from China. And I think, the potential from India has to be at least that, that many, not the, 50 odd that we currently have. And this could be, the next 2 or 3 years that I believe we could see that sort of potential, from India. Of course, the key 3 main drivers and 2 main challenges in my view, accessing investors that you don't have access to otherwise. A broader investor base is the number 1 reason. Particularly if you're in some sectors, if you're an early stage company, a startup. I know many companies today, are here because NASSCOM's a partner to this event. At an early stage, there aren't, all markets aren't appropriate, all investors aren't appropriate, and you can't access some of those investors. Second, of course, is the improved valuations. Particularly for some sectors, there are markets that focus on some sectors. And of course, third is just the brand visibility of being an international company. The 2 biggest challenges, of course, are dealing with these current Indian regulatory constraints, which we believe will be taken out soon, and of course, complying with foreign regulations. I'm sure Sanjay, my colleague, will talk in a lot more detail about that. So in summary, just to conclude, it's a matter of when, not if. As many as 37% of companies listed in London, 14% on NASDAQ are overseas companies. Since 2012, 130 companies from the Asia Pacific region have raised over $50 billion in the US. Over $50 billion in the US, over 40,000 crores since 2012. Whereas, maybe 2, 3, 4 companies from India. 25% of them are now looking to do a follow-on offering. So therefore, we really are very confident that we will see a significant number of Indian companies. I believe, and we believe at Grant Thornton, technology and renewables will be some of the sectors. There'll be early adopters of that route when that opens up. But at the same time, they should not scare anyone. Not everyone can, should, or will list on overseas markets. There will still be a buoyant opportunity for people to continue to list in India, and indeed, pursue dual listings. And really, in our experience, many of our most successful clients who did really well, first accessed an overseas market, then also pursued a listing in India, whether of that vehicle or their, Indian business, and at some stages, delisted from the overseas market. Many of them first accessed a smaller board, AIM, and then graduated to LSE. And I think, as I said, we have a number of experts you should hear from on that opportunity, on why you should consider an overseas listing. I talked about some of that. So without further ado, I'd like to introduce to you my good friend, client, CEO of WNS, somebody who's had personal experience of building not just one company that has had an overseas listing, but two. Before WNS, Keshav was at Sintel, and Keshav has had terrific experience of direct experience of listings overseas. Keshav has, of course, built WNS into a company with more than 3 billion in market cap, a fully integrated company by industry verticals. Keshav, very warm welcome here. Over to you. Would you like to share with the audience, why should people consider an overseas listing? What are the pros and cons of that? And who is it perhaps not appropriate for? Maybe a good place to start, or at least cover, versus who is it appropriate for? Thank you.
Well, thank you, Vishesh. Those were excellent and very relevant comments. And thank you, Thornton Bharat, for inviting me for this session. As Vishesh mentioned, I've been lucky to have run 2 US listed companies, and maybe some of that experience is relevant. I also know that at today's session, not only are we having many experts who probably know this subject quite well, but a lot of our esteemed colleagues from the MSME world, from NASSCOM, who are here and who will probably be the future of India. And therefore, I think this session is so useful to particularly them, because it gives them a sense of what the practitioners are saying about many things around this particular topic. So let me first begin by saying that the Union Cabinet's May 2020 approval to allow direct listing for Indian companies in overseas exchanges is an extremely positive move and a step absolutely in the right direction. While many may perceive this as access to lower cost capital, what is most important in my mind is the trust it will generate in Indian corporates and leaders. Indian businesses have always had access to international investors through the FDI route, as we know, and which has consistently grown with reforms over the last 2 decades. We've also had access to the ADR and the GDR markets, which was, in my opinion, more an indirect route to the overseas listing. And India's policies and corporate governance have actually matured significantly over the last few years. However, I still feel that there remains a bit of a trust deficit with international investors due to some legacy mindsets that often take time to change. Investors in India and abroad are becoming increasingly concerned about the impact of businesses on environmental and social factors. They want to ensure that they invest in corporates that take accountability towards a better future and have more responsible governance. To me, this is an extremely smart move, this announcement made by the Indian government, because not only does it protect against multiple global policy changes in the future, but it also frankly helps ensure that businesses will have customers available in times to come. Investors and buyers want to do business with companies that they trust inherently. Trust them for good governance, which includes a positive contribution towards local communities and the environment, no exploitation of labor, no misconduct, incorporating fair employment practices, promoting diversity, reducing their carbon footprint, and finally, I will say investing in practices for a better tomorrow. I strongly believe that Indian corporates have moved the needle significantly in every one of these areas and have very strong corporate governance, which sometimes tends to get impacted by negative media that may focus on a few company actions or some legacy news that is being brought out every now and then. Having said this, I would like to also clarify that this will not be easy. The burden of evidence, the cost of compliance can be heavy, and therefore this may not be the route for everyone to take. As corporate leaders, you must take a lot more responsibility for the actions of the company and its employees. Therefore, I believe you must invest heavily to ensure robust controls, compliance, and to keep yourself out of any potential penalty box. Sometimes for startups or those with small capital needs, there may actually be a better alternative source of capital. So in short, you may not be ready for this route yet. For those who are looking to diversify into international markets or even within India and want to work with local offices of international brands, overseas listing will play a really major role. International brands, especially those that want to manufacture in India to supply to other countries, must comply with certain conditions. They need to show that they work only with those suppliers who have similar corporate governance, have fair employment practices, do not exploit labor, or promote any kinds of malpractices. Overseas listing and related compliance may make you much more eligible to work with such customers. Also, in some cases, an overseas listing will excuse you from certain complexities, such as bank guarantees, to apply for business. It may also help in hiring employees from international markets whose expertise will be necessary for you to expand. This increases your access to more business, more clients, and more markets, and therefore sets you up for better and faster growth if you go down this route. Once you decide to go for an international listing, there are many other factors to be considered. Where do you list? Which country? Which exchange? ESG, which is the new hot topic that all of us are grappling with at this point in time, is not mandatory, but important to many investors. So are you going to comply? The cost of listing is lower in the US compared to Europe. However, if Europe is the key market for you, then you may have other advantages. There are still many unanswered questions in the Indian government policy framework that you will need to keep in mind, such as taxation, SEBI jurisdiction, and FEMA. I'm sure all of this is going to be discussed a little later. So you will need answers to many of these questions, for which you will need to work with experts who can really help you. In summary, if you ask me, this is an extremely positive move for Indian businesses at large, with a lot more access to capital, potentially lower cost of debt, access to more customers and employees, ease of diversification. This change is bound to bring in a new era of growth for Indian businesses and India as a whole. For you personally as a business, what you must first decide is, what are you looking for? Is it capital, customers, employees, new markets? What is it? As I said, access to capital has always been there, although indirectly. Only for access to capital, unless you're looking for a large source of low-cost funds, an overseas listing may not be the right choice for you. For those who want to grow their business with access to international brands, customers, markets, and diversification, I must say it's a boon and you must go for it. As I mentioned earlier, I have the experience of running two companies earlier, one listed on NASDAQ and the current one that I run, WNS, listed on the New York Stock Exchange. And while both were already listed when I got in, I have managed every other aspect and I've had great experience thanks to these listings. Access to clients, capital, strong governance, world-class talent, low-cost debt, total transparency in all that you do, focus on key initiatives. ESG is one, diversity is the other that is our hot topics at this point in time. And all these go beyond your business. Before I end, separately, I can tell you, you cannot beat the high of opening or closing the market on the NYSE or NASDAQ. It can actually be life-changing to see your team featured on the NASDAQ Times Square building. Well, if you want to go ahead with it, this is the time, and I wish you the very best to grow. Thanks a lot.
Thank you. Thank you, Keshav, for that very inspirational stuff. I think life-changing moment. Clearly, at least for me, I think one thing that really came out is, as you very clearly defined, the trust factor. That second, clearly, at least for me, it was beyond access of capital, international brands, customers, best talent, and of course you identified the challenges, but for me I will always take in terms of the moment when actually you ring the bell and for an overseas listing. Thank you, Keshav, sincerely from all of us. Well, we'll move to my colleague Prashant Mehra. Prashant is my colleague. He's a partner with Grant Thornton Bharat. Prashant has got significant experience on capital market transactions, has spent time in the UK and has assisted various Indian companies to list in the UK market. So Prashant, over to you and to kick off the panel discussion.
Thank you, Raja. I mean, undoubtedly and truly seems to be a huge opportunity for Indian corporates to remain Indian and yet access global stock markets. I remember, thank you for, telling everyone about my experience. And I remember that when we were helping Indian companies list on the AIM market, and I think probably every Indian company that's been listed on the market, we've been involved in some capacity or the other. But I think the high was, as Keshav also mentioned, that I was accompanying one of our clients, and when we together put our hand on the buzzer to ring the bell for the opening of the exchange, I think it was the adrenaline rush is incomparable. And I think some of our attendees will probably go through that adrenaline rush just about hearing about the opportunity from our experts. But how big an opportunity is this? What are we really talking about here? I don't think so you and me can cover that, and which is why we've got some distinguished speakers who amongst them have a wealth of experience on helping Indian companies access global capital. My first guest is gentleman Bharat Reddy. Bharat Reddy is the chief representative from JP Morgan. JP Morgan, as all of you know, is a leading international investment bank. Bharat has immense experience on helping Indian companies go global to access global capital markets. Bharat, my first question to you, firstly, if you could tell us something about your experience in this space, and secondly, how big an opportunity are we really talking about here? And is this really such a big opportunity for Indian corporates? Bharat?
Thank you, Prashant. First and foremost, I would like to thank Thornton Bharat for giving me the opportunity to be on a very distinguished panel. I think you're absolutely right that direct overseas listings at this stage is a fairly significant development for Indian corporates. This will give an opportunity to companies incorporated in India, which are unlisted, to have the ability, freedom, and optionality to choose where to list based upon a number of factors like cost, valuation, branding, etc., which both Vishesh and Keshav have very eloquently discussed in the preamble. Specifically, technology companies in the healthcare sector, certain biotechnology sectors, renewable energy companies have been keenly waiting for this development, as it gives them an opportunity to list on global exchanges and be benchmarked to global peers. You see, currently the regime was such that Indian companies had to undergo a fairly significant cost restructuring in terms of their holding structure if they wanted to list overseas. So the direct listing enablement and this route will remove this frictional cost, which will be, I think, a very significant incentive. Also, for issuers, it makes a difference to be evaluated by the analysts in certain markets, which have far more experience in these particular sectors. So the valuation of the company gets fleshed out, and clearly the opportunity for investors to evaluate some of these new age companies is significantly greater than it is purely in the domestic market. Also, for the flipping the issue to the investor side, there is clearly a convenience factor which is added to a home market advantage. If they see something which is a dollar-denominated security, which is listed in a market which they understand, it makes it that much easier for them to make a decision to invest. It's also traded in a time frame which is convenient for them during their daylight hours. There are a certain class of investors, particularly in the United States, where their articles and memorandum of incorporation prohibit them from investing or having a portfolio investment in anything which is a dollar-denominated stock. So clearly, this additional pool of capital would also be available for Indian companies which would perhaps participate in a direct listing. Also, the market infrastructure in some of these markets is significantly better and more familiar to overseas investors, and their ability to participate in listings which are there either in the United States or on the LSE is significantly greater. And last but not the least, the legal responsibility, because their ability for enforcement of contract, tackling things like source-based taxation is much greater in terms of comfort level in their own jurisdictions. So I think this opportunity is going to be very significant. I think the comments coming out of the Federal Reserve Bank of New York under Governor Powell that interest rates in the United States are unlikely to see any significant rise till the year 2023 gives a very significant opportunity for the liquidity which will be generated to be attracted to Indian companies exploring this route.
Thank you, Bharat. Better infrastructure with some overseas markets, a different set of investors, perhaps a team of analysts who understand certain sectors much better sitting on those markets. Let's get some stock exchange perspective here with my next guest, Bob McCooey. Bob is Chairman Asia Pacific at NASDAQ. Bob, welcome to the panel. again, I don't think so. We need to talk about your experience, but really from an Indian perspective, I mean, how do you see this? Is this really such a big opportunity, and how is America welcoming this opportunity to have Indian corporates on their markets?
Thank you, Prashant. It's so nice to be here with all of you. And I think that a number of the things that Bharat just indicated are truly some of the benefits of not only an overseas listing, but certainly a U.S. listing. Um, I think I mentioned to a number of you that every year we do our planning for the following year and try to understand which parts of the globe outside of the US markets are going to be busy. And for a decade or maybe longer now, I have said, oh, I think India was going to be just an amazing opportunity for us next year. And it's gotten to the point where I have felt like, Don Quixote, where I am the only one saying it and going through a barren desert alone, with trumpeting what I think is one of the great opportunities of the world in terms of listings, in terms of corporates, in terms of companies going publics, and also in terms of entrepreneurship. One of the things that I like to say is that entrepreneurs are not, and the idea of entrepreneurship is not an American idea. It's not fundamentally something that's ours. It doesn't exist just in Silicon Valley and Austin, Texas, and New York, and a few other places. It exists around the world. And clearly, one of the things that we spoke about earlier, that I think Vishesh touched on, is the fact that there are so many of these Chinese companies that have come to the U.S. markets. And we're so pleased that a number of them have been listed on NASDAQ. We actually total about 160 Chinese companies, including 5 of our NASDAQ 100 companies. But those companies are founded by some amazing entrepreneurs. And there's no doubt that there are equally amazing entrepreneurs who would like to be viewed on a global stage, and they're from India. And so we think that the U.S. investor has been excited about this opportunity. They want to be able to directly invest in India. They see the largest group of individuals in the world in any one country as being such an amazing market. The market opportunity is there. The entrepreneurship is there. The technology focus is there. And I think they would love to bring their capital into the country in a way to participate in the growth of India and the growth of these companies as public companies. Most companies belong in their local markets. So for all of you that are listening, the idea that Gokul on LSC and myself are going to use this as an opportunity to come in and take all of your best companies and bring them, or take all of your companies and bring them to our markets, is not what this regulation will do, and not what the fundamental facts will show over the next decade. What will happen is that some companies who decide that this is the best path for them will list outside of the local market, and oftentimes because they want to create a global brand. WNS is a global brand. Infosys is a global brand. And to be able to be listed in a market outside of your local market and still have that optionality discussed earlier of listing in your local market is something that all companies should have the option to do. And so we really, Prashant, are very excited about this, especially because so many companies fall into the areas of NASDAQ strength. Technology companies, renewables, global consumer brands, those are the ones who have been attracted to NASDAQ over the past 49 and a half years that we've existed. And we really look at this hopefully in 2021 as being finally the year that Bob is right, and that India ends up being a great opportunity for us for the next succeeding decades of companies that will have the option of coming to the US markets, and hopefully a number of them to our market.
Indeed, Bob, very useful comments, but what really stayed with me was, your when you said next year, and I have a question on that, but let's first get some comments from your counterpart from the other side of the Atlantic. With that, I come to my next guest, Gokul Mani. Gokul is head of primary markets, Middle East, Africa, and India. Gokul, welcome to the panel. If we could, have your comments as well. I mean, as far as Indian companies listing on global markets, perhaps UK has a bigger share than the US. So what has been your experience, and how big an opportunity do you see this particularly for Indian companies? Welcome, Gokul.
Well, thank you, Prashant, and thank you to Grant Thornton for having me here. To answer your question, I think historically, how much time did we spend on Indian opportunities? Quite a lot, because we've had a good international market share of listings from India, and then recently a little less. But over the last couple of years, my colleague in India, Mohan, and I have been inundated with conversations that are around the overseas sole listing policy. And conversations mainly in the technology, renewables, and payment space, broadly defined. I think this policy, it's all about optionality. And by that, I mean, Indian companies in any sector don't have to list, and by no means do they have to list internationally. This opens up an option for them, an option that is a sole international venue, or a sole venue followed by a dual venue. So I think with that outlook, right, it's not, they don't have to do it, but they have the option. I think it shows a certain degree of capital market maturity on the part of Indian government and the Indian regulatory matrix, because historically, companies did have to, as mentioned earlier in this event, companies did have to externalize their topco structures and go public if they wish to on a sole basis. Now they're allowing this without that in place. So it's showing that kind of maturity in the system. Maybe the final points I'd like to make is what can an international listing do for an Indian company? I think it's all about putting some of those large Indian technology and other companies on an equal footing, on an equal cost of capital footing, and in an equal sort of, go after international clients, international markets footing. Because an international listing will allow you to grow your brand, your people, your business in a more accelerated fashion internationally outside of India. And I think what we will also see is more global M&A on the part of Indian companies. Indian companies have done M&A overseas, both for cash as well as for stock. There's no denying that. But having that international listing, I think we will see more of it. In recent times, we've seen the big billions of dollars that make the headlines we've seen is international capital coming into India. I think a policy like this will of course, first the companies will go public internationally, and then they'll make some very large acquisitions. Our view is they'll make some very large acquisitions, paid for in stock, and really put India in kind of the global M&A map. Thank you.
Thanks, Gokul. Let's quickly get some comments from someone who's been working with Indian companies for quite a few years and has got some experience there. My next guest, Frank Giglio, MD and Head Depository Receipts, APAC, based out of Hong Kong, BNY Mellon. Frank, welcome to the panel. Yeah, you've had some experience of working with Indian companies, helping them raise capital more around ADRs and GDRs. What is your take on this opportunity?
Thank you very much, Prashant, and again, thank you for having me. Yes, I've been very fortunate over the last 10 years, even when I was with NASDAQ and came to the region on a project at the Singapore Exchange, working with issuers across the region and very specifically in India. I really look at this as a huge opportunity because I know firsthand the demand for more access to companies in India from specifically the US investor. I think my colleagues, Bob, who I used to work with for a number of years, and obviously Gokul at the LSC, they really covered all of the key aspects, optionality, maturity, and really the attributes of the Indian market. So I don't want to spend too much time on that, but I will say what we've seen and what's really important around maturity is we've seen it here in Hong Kong. Hong Kong has continued to change their regulatory listing environment. And to be honest, internally at BNY Mellon and maybe at some of the other banks and the exchanges, there was probably some nervousness about what that would mean. What we have seen, and the numbers do not lie, and again, this is going back to market maturity and optionality, allowing these rule changes have allowed more companies to access public markets. And that is a good thing just straight across the board. We've seen more listings go to the US. We've seen more listings come to Hong Kong. We've seen more listings come to the new technology, and I'm sure Bob's going to like this, the NASDAQ of China in Shenzhen. These market evolutions, these continued options which are presented to technology companies, startups of where to list, it is just tremendous for the ecosystem overall. And all it has done is just continue to increase the number of companies that are able to access public markets around the world. So to see this, really gain some steam out of India, we all know on this call, there are just such tremendous companies, companies that are in such demand, and US investors are really chomping at the bit to be able to own them. And as Bharat said, to be able to own them in US dollar and to be paid those dividends in US dollar, that just opens up such a big portion that has truly been closed off for some time. And it's just a huge, huge overall opportunity.
Thanks, Frank. I remember, when Indian companies were listing on the AIM market, those were exciting times, and I think we're in much more exciting times. I mean, we've got a supportive government which is coming up with progressive reforms. This is probably an example of that. We've got a robust economy, but a point which everybody's been mentioning, that as compared to then, we have a much more matured corporate sector, but I would say at the same time it's dynamic as well. It's both maturing as well as dynamic, which is probably the opportune time for them to start looking at international listings. But we can't do an international listing without a council. So that takes me to my next guest speaker. We have Rajiv Gupta, partner at Latham & Watkins from Singapore. Rajiv, welcome to the panel. I'm aware that you've got immense experience of working with Indian companies specifically on overseas listing opportunities. Rajiv, you were also involved with the legislation. So where are we, and what's your view on this opportunity for Indian corporates?
Thanks, Prashant. Thanks for having me here. Nice to meet everyone. So, I think, folks before me gave a bit of background. I think Vishesh mentioned some background on what has been going on in the Indian, historically on the overseas listing, on the regulations. I think 2018, SEBI formed a committee to recommend a framework for direct listings by Indian companies and listing in India by foreign companies. I was very privileged to be a member of that committee. The framework was published publicly for a draft framework for public comments towards the end of that year, early 2019. Since then, as you know, there has been a lot of public news around it that the framework, a circular based on that framework, is likely to come out. It's all speculation, of course, at this point, and there is nothing concrete. So we don't know the timing and what the content would be. There is always, and you all seen the news, whether there'll be a dual listing clause or, it would just be a single listing. So we'll have to wait and see what the final rules look like and when they come out. But I think the fact that SEBI committee was formed shows that there is a commitment from the government to take that step. And all the recent, and there was a company's amendment bill that passed recently, which is a step in the same direction. So there is all these legislative activity that's been going on and the regulatory activity, which points us all in the right direction. So I can say we are hopeful, but at this point, we'll just have to wait until the final rules come out.
So thanks, Rajiv, for that. Before I move on to my next guest speaker, Bharat, if I could just request you to come in here. I mean, I'm aware that you've also been involved in certain capacities with the authorities on the legislation. Where, according to you, are we? I mean, it's been 6 months since the government had mentioned this and there was a cabinet clearance. Where are we exactly on the legislation, and when can we tell Bob that enough of waiting, we're finally here?
Well, genesis of the entire legislation comes out of a SEBI committee of 2018, which my friend Rajiv was on, which he just spoke about. But however, at this point of time, you see the Companies Act amendment has been enabled by both houses of parliament and has been also brought into law by the president of India signing the piece of legislation. Our understanding is that an umbrella scheme similar to the depository receipt scheme will be required to be notified by the Department of Economic Affairs or the Ministry of Finance. Similarly, the Reserve Bank of India would also require an amendment to FEMA, the Foreign Exchange Management Act, to permit such issues. Both these are administrative tasks which shouldn't be too difficult to put through. However, a slightly more tricky bit is around the taxation issue. Currently, under Indian law, income earned from transfer of equity shares of an unlisted Indian company listed on a foreign jurisdiction would be subject to capital gains tax in India, as these shares would be considered capital assets situated in India. Therefore, a specific exemption would be required to make the scheme operative. Similarly, under certain sections of the Income Tax Act, if a person receives shares of a company incorporated in India for consideration, which is less than fair market value, and this fair market value is also determined by certain valuation norms prescribed under Rule 11 of the income tax rules, then the difference between the fair market value and subscription price would be subject to tax in the hands of the person acquiring the shares. So, obviously, if you do a direct listing, then you permit market forces to find what the valuation is, rather than have any fair market value arithmetical deduction. So a waiver would also be required from this clause. Now, whether these amendments require a change in the Income Tax Act, or they can be done procedurally by a notification by the income tax authorities, is a matter which is being debated as I gather. Also, the point which Rajiv spoke about, whether a secondary listing in India would be required within a stipulated time frame, that would then, obviously result in a equity overhang when investors would know that a liquidity event would occur within a prescribed time frame. So I think a number of representations have also been made to the authorities to leave that as an option rather than as a stipulation within a specific time frame. So what shape eventually the regulations will take remains to be seen and involved. But we are very hopeful that this will be operative over the next few months.
Thanks, Bharat. With that, let me just ask my colleague and fellow partner Sanjay Banthia. Sanjay, I'm aware that you're the subject matter expert on international reporting obligations. Given your experience around advising Indian companies and I know you've been following the legislation also closely. So two questions for you there. One, of course, how big an opportunity in your mind is this for Indian corporates? And secondly, do we see anything in the legislation which could be a challenge for Indian companies as such?
Thanks, Prashant, for having me here. I would say private and public companies will always coexist because that's how it's meant to be. But the most successful companies do choose to become public at some point in time. In the global pandemic situation that we are in, the macro growth will remain moderate, and investors will pay premium for higher dynamic growth companies. And clearly, on account of the lack of liquidity or current volatility, lack of mature investor base, or inability to access global investors locally in the emerging growth exchanges that we have, the developed exchanges will definitely be a great opportunity and will create right optionality for Indian companies with a high entrepreneurship that remains in India. I would say that's, in my view, a great opportunity for Indian entrepreneurs, particularly who believe that they will be able to give a high dynamic growth in the coming period. And the fact that I've been following the entire changes and legislations very closely, one of the key recommendations that we believe would be important to see how it comes is whether the Indian MCA will allow these private companies to continue to file the financial reporting under IFRSs with a reconciliation to Ind ASs, and that would reduce a lot of burden on these companies which choose to go public overseas through this regulation altogether.
Thanks, Sanjay. I actually have a follow-up question on that, but before that, let me just get some comments from the major exchange representatives. I'll come back to you, Sanjay, on my follow-up question. Bob, quick question for you. I'm aware that our government is talking about Atmanirbhar Bharat, that frankly means self-reliant India. In a sense, what it is doing, it's allowing Indian companies to stay Indian and list overseas without having to set themselves up as international companies. So what are the specific advantages of the US stock exchange, and in your case specifically NASDAQ, over other exchanges?
Well, we always look at it kind of in five or six different buckets. One is the company you keep. We have the 5 largest companies in the US capital markets and 5 of the largest companies in the world listed on our market. So to be be a technology leader and be among the Apples, Googles, Microsofts, Intels, Facebooks of the world and sit alongside of them on NASDAQ is pretty heady company to be able to be part of the NASDAQ family. And we've had great success in attracting companies both from around the world as well as from our domestic competitor who have transferred to NASDAQ. Liquidity is a huge, a huge item that companies think about. It's something that's high on the criteria list, and NASDAQ has the deepest pool of liquidity in the US capital markets, and the US capital markets are the deepest pool of liquidity in the world. So when you combine those two factors, it's a magnetic factor for companies who not only are doing an IPO, but are going to be coming back to the market to raise money on an ongoing basis. So if you are building a business, if you are a biotech company who's going to have to continue to raise money, if you're a financial that is going to come back to the market in order to continue to raise money, you want a market that is deep and liquid, allows you to continue to raise the capital that you need to build your business. One of the things that Frank touched on is a very key differentiating factor for NASDAQ versus any other global exchange is the fact that we have a services business embedded in our DNA. We began building this services business back in 2005 with an acquisition, and then have organically built other services as well as acquiring ones at NASDAQ. And they really focus on the investor relations suite, because if you are a Indian company or a Chinese company or an Australian company or a Argentinian company like Mercado Libre, you know, when you come to the US, you have a brand new set of challenges, and they go far beyond language challenges. You have to understand how to really understand who your shareholders are today, target the right shareholders for tomorrow, how you engage with them, how you have the right tools for tracking them. And we provide those services to the companies that list with us. We have a huge business and a huge focus in it, both on the platform side, as well as using human beings in our advisory suite in stock surveillance and targeting and perception studies. And one of the topics that was talked about earlier, ESG, which is a super important topic for us. And then the final two areas are really the marketing and branding that NASDAQ does. And I think that really sets us apart. And as companies come from their local market to a global stage, that's what they are really searching for, is the amplification of that event, the IPO, and their ongoing branding and marketing that NASDAQ works on with those companies. And we do all that we do at a very low, attractive fee schedule. So that helps keep companies, keeps the dollars in their pockets, allows them to continue to grow. The one other area I'd like to touch on is the fact that we also have the NASDAQ 100, which is unique in the fact that, first of all, NASDAQ has an index business. It's one of our public company business units, is our global index business, our global information services business. And in the US, there are three major indices that are widely followed. The Dow, a very narrow 30 stock index, 5 companies from NASDAQ, 25 companies from New York Stock Exchange. The S&P 500, about 200 stocks from NASDAQ, 300 stocks from the New York Stock Exchange, both of who, Dow and S&P, exclude foreign companies. The only major index in the US that allows for foreign companies to be part of that index is the NASDAQ 100. And we saw our 5th Chinese companies, Pinduoduo, join the NASDAQ 100 this summer. They joined Ctrip and Baidu and NetEase and Jingdong in the NASDAQ 100. We have, for example, I just mentioned Mercado Libre from Argentina as part of the NASDAQ 100. So it's something that's very unique to NASDAQ, and with some of the amazingly large and fast-growing companies out of India, that would be another way for them to really launch themselves onto a global stage to be part of this major index that's tracked all around the globe.
Thanks, Bob. I've got something specifically to ask you on the Chinese startup space, but in a moment. But before that, Gokul, if I could request you to come in and tell us how do these advantages look from an LSE's perspective?
Sure. Thank you, Prashant. And I think what I'll try to do very quickly is try to give a little bit of a UK versus why the LSE versus, let's say, our global exchange competitor set, and then maybe a little bit about why LSE versus the domestic Indian indices or exchanges. Sorry. So I think on the LSE versus our global global competitor peer group, I mean, the global exchange space, and it's a real privilege to be here with Bob. The global exchange space is basically around 4 or 5 exchanges, right? It's in no particular order. It's ourselves at the LSE, it's NASDAQ, NYSE, Hong Kong, and Japan / Shanghai. So that's your kind of global sort of majors. Why LSE versus any of these? Well, on the LSE, you have an investor base that is used to investing in Indian situations and really knows India. So that's a huge positive. I think in the asset management industry, even more broadly defined, and this pertains to listings on NASDAQ as it does on our market. The asset management industry has a lot of actually Indians, ethnic Indians that are actually managing global portfolios, EM portfolios. So you've got that familiarity and understanding. 37% of the 2,500 companies listed on the LSE are actually not from the UK. They're not from Europe. They are from markets outside of UK, Europe. Therefore, our investors are used to investing in global stocks, EM stocks. In terms of investor diversification, less than half of the investors on our market by value are actually from the UK or Europe. 48% is UK European investors. The rest are actually US and Asian investors. US investors own 35 to 40% of the LSE market. So it's a very broad and diversified investor base that you get access through via a listing on our market. As Bob mentioned around some of the NASDAQ indices, we've got the FTSE indices, and I think similar to some of the indices that they manage, these are indices where foreign companies get index inclusion. What does FTSE give you? FTSE gives you up to 13% of your issued share capital to be owned by the whole wall of algos and passive funds and ETF demand. So that's powerful. Maybe I'll move on to just a couple of thoughts of the LSE versus the domestic indices. And I think there we're replaying a lot of what we already went through in some of the comments earlier on in this event. The comments around incremental shareholders, around a differentiated valuation technique that we'd like to say appropriately values high growth tech, renewable and payments companies, and probably, you know, it's an international venue is a better launch pad for an international growth strategy for the business. Thank you.
Thanks, Gokul. While we're talking about Indian corporates, I think it's also important to understand, how investors perceive India. And on that note, if I could request my colleague Raja. Raja, you had a few questions around investors and markets.
Yeah, thanks, Prashant. I guess before I take that, it'll be good to just get some context around exchanges. There are some great comments on the chat box, so I will possibly pick up a couple of that. So maybe if I may come to Frank. Frank, if you look at from a perspective of an Indian corporate, right? So there is the smaller companies, there's the mid-sized companies, and of course the larger corporates. Now, how do you choose exchanges, right? There is, of course, UK, there is US, there is Singapore, and so many jurisdictions. Now you've obviously worked on various of these situations. Now, if from a corporate's point of view, what are the 2-3 factors they should keep in mind while selecting where to list? And that'll be great advice for entrepreneurs.
Absolutely. Such a great question. And there are, and I'm sure it can be extremely overwhelming when having to make a decision such as this, as these markets continually compete for greater access to these companies. But I think going back to some of the earlier comments and what you are ultimately searching for with this move to the public markets, it's access to clients, access to capital, access to different consumer markets, et cetera, and employees. So there are a number of different things to keep in mind. I really think where, back to Bob's comment about as this potential legislation is passed, specific aspects are worked out, it is not BNY Mellon's or the specific exchanges to come in and go after every company in that particular region. We're looking at companies whose peers are based in the US market, where there is significant analyst coverage for those companies, and where there's just essentially investors have significant experience in investing in that type of company, meaning high growth technology, a company that may not be generating any real revenue at the moment, technology, biotech, et cetera. US investors, European investors, they have a great deal of experience, and they're very confident in their ability to value these companies. So, taking all of that into play, and are you solely a domestic play? Are you looking to expand overseas? Or is it just a play to access capital? All of that does come into play. And I would say what we continue to see and expand here in the region is, yes, it really was initially a China play, meaning companies from APAC, being China, moving to the US IPO. Now we are having conversations. Obviously, we are seeing a number of live examples coming out of Singapore. But if you look across Indonesia, you look across even Tokyo, Japan, there are more and more technology companies that are considering the benefits, which are multitudes, of what the US and these other markets have to offer. And it's my final point of that is, because it is so overwhelming, it's really important the partners that you choose that have that experience and can filter through some of that and really get down to what is key to you and what you're trying to achieve as a company.
Hey, Raja, can I just jump in and say one?
Absolutely.
So I think going back to something that I said earlier, and I think the word optionality has been used a number of times, and Frank talks about live transactions, but there's been a lot of activity around Hong Kong over the past year or so. Clearly, they changed their rules. Some large Chinese domestic companies listed there, like Meituan and Xiaomi. Things went well. Alibaba waited a year, and then they did a dual listing. And now we've seen a number of large NASDAQ listed companies, some of our NASDAQ 100 that I just referred to, doing a secondary listing, doing a dual listing in Hong Kong. And I think that is a wonderful situation that I would hope that the Indian market, the Indian regulators, the domestic markets look at as giving this optionality, not confining it to any particular period of time. Maybe it happens in a year, maybe it happens in 5 years, but it allows for companies to come back to India if they've decided to do a listing on LSE or NASDAQ or Singapore or anyplace else, and then come back and list. I mean, we just saw GDS, which is a data center business from China, listed 4 years ago. Had a sub $10 billion market cap. I think maybe even sub $5 billion market cap when it originally listed. They just dual listed in Hong Kong. The stock was at $10 when they went public. They're at $97 today. They have a $35 billion market cap, and they just raised $1.5 billion on Hong Kong. And I think it goes to NASDAQ's philosophy. We're not in the business of trying to attract companies and keep them captive on NASDAQ. As you look at our business as a publicly traded company, we're supportive of the global capital markets, whether it's our market tech business, which supports the National Stock Exchange of India, providing them with technology, or whether it's our global information services business, or whether it's our corporate services business. Across our businesses, we're very inclusive rather than exclusive, and trying to be as supportive as we possibly can. And so we applaud the fact that companies have taken the additional step to raise capital and go back to home or local markets in order to give access to new investors.
Yeah, thanks, Bob, for that. The optionality factor is very clearly coming out. Well, I'd like to bring in Gokul here. I think Gokul, as you very rightfully mentioned, that obviously LSE London has deep knowledge of the Indian businesses, Indian corporates. I think one of the issues have been the challenges, right? I think Keshav mentioned about governance, right? Some of the challenges on the regulatory front in India, some of the sectors which have gone through stress. So how do you see that from an exchange perspective, or more than an exchange, let's say from a global investor perspective? How do you now perceive, let's say, Indian corporates? Because it is not just the rosy picture. There are challenges, sectoral challenges, uh, regulatory challenges, and of course, how do you kind of raise your bar to the standards of governance? So it'll be great to get your viewpoint in terms of how do global investors like yours, having seen so many investor blocks, see Indian corporates today, in today's context and in the future.
Thank you, Raja. I think your question is around maybe some of the, if we dial back the clock a bunch, some of the situations from India on AIM, which perhaps I think one of the panelists mentioned that maybe shouldn't have ever listed. I think that's your question around governance, and I think how do international investors think about that, and how they poise to welcome news stories on international venues. I think enough time has passed between some of those governance and fraudulent situations and today. That's one. Number two, a big change between then and now is a phenomenal amount of international private equity, international strategic investor, and Asian private capital has invested in India. And the majority of those stories have been in the technology space. And therefore, there has been an implicit, embracing back of Indian governance, Indian management teams, and Indian equity stories. So that's my second point. What often changes the tide is that first transaction, that first couple of transactions as part of direct listings, no matter where they list, no matter which of the 9 or 10 jurisdictions those guys list, they have to trade well, they have to be good equity stories, and they have to be market successes. I think a combination of that should then open the doors for direct listings right across the board. I picked up there's a lot of Q&A coming through in the chat around small and medium enterprises, around AIM, around what kind of what size of company is right for one versus AIM versus LSE, UK versus US, etc. And I'll take your lead if we want to cover off some of those points where we can.
And Gokul, if you could also cover, I think one of the perspectives people are asking is cost of compliance, right? Smaller IT companies, tech companies, how are they going to afford the cost of compliance? So it'd be great to get some thoughts around that.
Yeah, sure. So I think the cost of compliance question that I did see was a little bit around. I think one of the questions was around the dual listing.
Yes.
Potentially the dual listing point. So I think, and this goes back to I think Bob's point on the dual listing. We get this question a lot because 25% of all companies on the LSE are actually dual listed. Either they began life somewhere else and then dual listed on the LSE, or they began life on the LSE and dual listed elsewhere. And I do believe that really a dual listing only makes sense for a company when they are convinced that there is a captive investor pool, a captive shareholder base that they can access in the other market that they couldn't in the market that they're already listed in. So would it make sense for an Indian company to have an LSE listing and then be mandatorily be asked to list in India? Absolutely not. Should it be an option for them to list in India? Yes. Why would it work for them? Well, it's that captive pool of domestic Indian institutions and domestic retail that might want to invest in that story, and that's fine. So cost of compliance for a dual listed company is obviously more than a sole listed company. A dual listing only makes sense. I truly believe that a dual listing makes sense for larger companies. Some of the examples that that Bob gave of Alibaba, JD.com, GDS, etc. These are large companies. Some of the companies that enjoy dual listings on our market, Samsung, Rosneft, Ignitis, Kaspi, these are multi-billion-dollar situations. So I think cost of compliance is there. It makes sense for the larger companies. It shouldn't be imposed on the smaller companies. I don't see how an AIM company, a company that goes to our AIM market, and I agree with Vishesh's comments there, $25 million should be the minimum IPO size or capital raise for an AIM situation. $25 million of IPO, maybe $100 million of implied market cap. And to force that company to do then a dual listing in India doesn't make sense.
Sure. I think that makes a lot of sense. I think some kind of benchmarks is absolutely preferable. I think going back to Bob, there was obviously a question around SPAC, right? So of course, the direct listing is something, but we are all obviously hearing about a lot of SPACs getting created, and that's really creating an opportunity for listing. It'd be great to get your views, Bob, on that, and how does India play in through that?
Well, 2020 has certainly been the year of the SPAC. We've had a lot. It's been the year of a lot of things, but in the U.S. capital markets, there's been more money raised in SPACs this year than I think all the money raised in SPACs during the past decade. There are currently, just on NASDAQ, I think there are 120 SPACs looking for business combinations and 33 SPACs that are in the middle of business combinations right now. So over 150 SPACs in some form of either looking or executing a business combination. SPACs, I think we've talked about this for the better part of the hour, is that, again, it's about optionality. There are different paths that companies take to the public markets. Certainly in the US, there is the IPO, there is a direct listing. There's direct listing now put forth in front of the SEC, direct listing with capital raise, and the other one that has been around for a long time. I mean, SPACs have been around since the mid-1990s. So 25 years of SPACs, but it really has taken off with a lot of venture capitalists, a lot of private equity firms, and notable CEOs who have formed SPACs. And I think that high quality private companies are seeing inquiries from many SPACs before they become public. So if you are a well-known name out there who is whispered to be considering an IPO, there is no doubt that there will be multiple SPACs knocking on your door. And there are certainly benefits to a SPAC in terms of time, in terms of the ability to get yourself to the public markets with a sponsor, with a capital base quickly. It allows for a number of the insiders to create some liquidity for themselves, more liquidity than they probably would be able to do through an IPO path. Not as much as they could through a direct listing path where all the shares are tradable, but certainly taking the cash that's in the SPAC trust and buying a significant portion of, giving that to the current owners and buying a significant portion of the business is certainly very attractive to a number of people from tax reasons, for liquidity reasons, or others. But I guess without spending too much more time talking about it, Raja, I think that the companies that are thinking about going public should listen to the SPAC option I'm not saying that they should listen to 20 different SPACs coming to pitch them, but they should listen to the SPAC option and then make a decision as to whether that makes sense for them, and then decide, which of the currently traded SPACs they would like to engage with and see whether they get a business combination done. But it is really about another path to the public markets for companies, and I think one that we think will continue to grow over the next few years.
Thanks a lot, Bob. I guess SPAC's another option to cover. Now coming to Bharat. Bharat, the Indian startup story, right? Very clearly continues to flourish. 20 plus unicorns in India, backed by investors. In fact, this year we saw the maximum number of private equity investment, obviously, in one particular company, and there's a pretty massive amount of investment hopefully lined up as well. And the venture capital startup story continues to be robust. But when you look at, I think Vishesh referred to the China-India comparison in some capacity, but Chinese startups have flourished and really raised capital at very different stages. We haven't seen that so far from Indian startup perspective. How do you see this from the Indian startup? How should they be looking at this opportunity? Should they be looking at M&A? Because we've seen some M&As, of course, happen. We haven't seen those big bang listings yet. Great to get your perspectives, Bharat.
Well, I think popular perception is that it is believed that the Indian startup industry is about 10 years behind the Chinese gig economy. Chinese companies actually started targeting overseas listings post the global financial crisis, which puts it in a relatively similar time frame, around 2009 end. Prior to that, it was mainly state-owned enterprises which were listed in either Hong Kong, China, and the US. But the US portion, which was basically in terms of ADRs, was relatively small compared to their overall market cap. So around 2010, a fairly unique trend started, which also supports the 10-year theory. We saw several new age Chinese tech companies accessing the US market over the last decade, including Dang, Youku, Qihu, Renren, 58.com, etc. The average market cap at times of IPO of these companies was around $2.2 billion. Prior to 2010, IPOs from into the US from Chinese companies were mainly into hard asset sectors like solar, Suntech, LDA Solar, J Solar, or real estate. China Real Estate, Xinjuan, eHouse. Now, if you look at the comparatively in India today, there are about 30 plus unicorns, out of which several have private market valuations in excess of $3 billion. So they have crossed that, $2 billion threshold. With public market investors likely to value them significantly higher than what the private market does, we believe that the universe of Indian companies is now sufficiently large and evolved to seek a listing which benchmarks them to some of their global technology peers. Additionally, I think there is a strong school of thought that investor interest will be very high, given that several global public market investors like BlackRock, Fidelity, T. Rowe Price, etc., and technology-focused investors like Silver Lake and Dragoneer have significant private investments into Indian technology companies. So I think this is a golden opportunity, and India, being where it is today, has an excellent chance of getting some of its unicorns to do a listing and sort of benchmark themselves against global peers.
Thanks, Bharat. I absolutely means it's a golden opportunity for Indian unicorns to really be global unicorns. So now I'll pass it on to Prashant. Prashant, over to you for the next theme.
Thank you, Raja. I actually had a question for Rajiv. Rajiv, Keshav mentioned that investors and buyers would want to do business with companies that they trust inherently. So my question to you there is, when planning for listing overseas, what are the corporate governance imperatives? And in your from your experience, are Indian companies actually there?
Well, the benefit of a listing, say, it's all start with the US and I'll come to London, that an Indian company or, for that matter, a Chinese or an Australian company, they can get the benefit of it being a foreign private issuer if they have less than majority US shareholders, or they don't, if their business is primarily outside US and assets are primarily outside US, they can qualify to be a foreign private issuer under the US listing rules. And if they do, then they have a lot of flexibility on the corporate governance requirements. For a foreign private issuer, the only real substantive requirement is to have an all-independent audit committee. For everything else, they can default the home country rules. So if an Indian list company is going under direct listing rules, whatever the Indian Companies Act would require them applies to them. They can just follow that, and other than the audit committee rules. Now they can choose to follow a higher standard. So for example, majority independent board, have a compensation committee, which is independent, nominating committee independent, CEO, chairman separation. So it's really a wide canvas that they can choose from. But the important part is that it gives them, the option and the flexibility of going with the bare minimum of just the audit committee. And there are a lot of examples, around the world, not just India, globally, where initially when companies just choose to list with just the audit committee requirements, and for the others, they take the benefit of the home country rules. But there are companies which want to act more like a US issuer and follow more robust standards. So I always get this question that a lot of issuers, they run scared that, oh, there is a very tough corporate governance requirements, we won't be able to meet them. That actually is not correct. There are a lot of benefits available. Coming to London, if you are going for a premium listing, then you do have the more robust standards that London would require you, which, some of the ones that I just mentioned. There are, however, other ways of this, like a standard listing, where they do have, certain, again, benefits and exemptions available. So again, depends on, where they're listing and what benefits they want to take advantage of. But there are benefits certainly available to issuers.
And Prashant, if I may, I just wanted to add to it's Gokul. I just wanted to add a little bit to that governance point, Prashant. Thank you, Rajiv. This point around premium versus standard that you alluded to, absolutely. On the premium segment, there are those higher standards of governance, as well as then going back to a previous question, the cost of complying to those requirements. But the standard segment effectively allows you to import those home country governance and home country rules. And, case in point, the largest 6 IPOs that we've had this year, the largest 6 IPOs for 2020, not a single one has been on our premium segment. They've all been on standard segment. And the smallest capital raise amongst those has been $500 million. So we've had $500 million to $2.5 billion raised all on the standard segment by our top 6. I think going forward, we're probably going to see more international businesses going down the path of standard when they are a kind of a hot IPO. It's got scarcity value, management, and CEO wants a separate class of shares. They want to have a combined chairman and CEO. They don't wish to have a majority independent board. Any of the above, they're going to go standard. And when they're smaller than our main market requirements, they're going to go AIM. Thank you.
Thanks, Gokul, for reacting to that. Sanjay, my next question is for you. As per a recent report that I read, only about 15% of non-domestic companies that have gone for a US listing seem to have adequate financial reporting. I'm aware that, Sanjay, you are subject matter expert on international reporting obligations. So how massive shift is this for Indian companies to adopt international reporting requirements of the exchanges, and is it really challenging?
Thanks for the question. And I'll give a little bit of stats out there, Prashant. If you look at the trends of restatement in an IPO process that the domestic companies have gone through compared to foreign private issuers, particularly on US stock exchange, roughly about 6% of domestic companies did restatement. And I'm talking about 2018 and prior to that. And a large part of restatements are around revenue recognition, income taxes, and income statement classification. Those were the key top three areas that impacted restatement altogether. At the time of IPO registration, the companies also need to voluntarily talk about the material weaknesses that they've identified on the internal financial controls. And the top three that's been identified across the foreign private issuers as well as domestic companies remain to be the financial statement close process, the issues around lack of personnel with an appropriate experience on US GAAP or IFRS reporting, and in turn the IT general controls the company has put into place. These were the key challenges from a trend perspective that we have seen. Coming back to India, India applied Ind ASs, which are very akin to IFRS um, from 2013, 2015 onwards. Companies have been reporting from 2016 into Ind ASs, at least the first tranche of listed companies with a threshold of net worth. The second tranche moved in 2018. We see a lot of private companies because of private equity using Ind ASs for the purposes of reporting, which are very akin to IFRSs. Under the US standards or US reporting, if you're a foreign private issuer, you're allowed to use IFRS as your reporting framework. And clearly, with Indian companies doing Ind ASs for, I would say, half a decade now, there is a huge amount of resource personnel available with an understanding of that gap, as well as the financial statement closing process has improved on account of internal financial controls that were put into place by Companies Act in 2013, highly effective from 2015 for majority of the private companies above a revenue and a debt threshold. So I would say while it may look to be a challenge, and it's challenging across for both domestic as well as foreign private issuers on the stock exchanges, I still view in the context of what's really happened to India in the last half a decade on both financial reporting and internal controls because of change in Companies Act, it's a big opportunity as compared to a big challenge.
Yeah, thank you, Sanjay, for that. Where I was coming from, particularly since startups will be targeting this opportunity. So just wanted to understand, how big a challenge is it really for, new and upcoming companies. But let me just move to Frank quickly. Frank, I'm aware that we've seen huge inflows of foreign capital come into India. Either it's been through the FDI route or other routes, but yes, not necessarily public money. So how does this move change the investor base for Indian companies, and how would large global institutional investors such as pension funds and all, perceive this move?
So, what we are really seeing in the conversations that we have is, it is amazing how the private equity venture capital space is really starting to mirror that we've seen in China. We are seeing the same names that, initially, if you go back to 2010 or 12, had maybe 20 names in their portfolio. Those same firms today are truly holding portfolios of up to 400 some odd companies just in China. We are now seeing these names that were set up earlier in India really expanding their investment reach. And I think that is just kind of to the maturity, to the market maturation. And we will almost see that same type of growth from these pension funds. and these investors, the continued ability to, become comfortable with local regulations, especially as they're seeing the ministry and SEBI work to bring those rules more in line with global standards that ultimately provide greater flexibility for these companies, and make it, to simplify it, make it easier for these investors to invest, but at the same time, sell, get their money out when they need to. So, we really are seeing these steps being taken that clearly demonstrate the market is beginning to open up and just make it a little bit easier and giving the confidence, to these funds, whether they're private equity, venture capital, whether these the pension funds, these institutional investors, that they have the ability to really do with their money what they want without particular holding periods, significant taxes, whatever it might be. And that is absolutely the trend that we are seeing and have seen over the last few years.
Thanks, Frank. I mean, yes, I think that it completely changes the the field that Indian companies will start playing on with access to this global large institutional investors. Rajiv, would you like to react to that, please?
I think this question comes up, between companies choosing between an Indian IPO. Now, as you know, today, an Indian company can do an IPO in India with a all of 144A, sell to the large investors who have in the US and out of the US. And anytime it asks, like, oh, what's the real benefit of then getting into the US if we're already getting these investors? I think that a lot of the other benefits that a lot of my, the panelists talked about is not just the investor base, it's also goes way beyond that. But just on the investors, there are a class of investors which in the US, and I'm sorry, I'm talking about just US right now, and I'm sure London has a similar concern. In the US, there are, a lot of investors who either are not willing to or are required under their own rules to only invest in companies that are listed in the US. And these are fairly large investors. So you, first of all, lose out those investors if you are only listing outside the US, and you can tap into them. Secondly, there are investors who may not be willing to comply with the SEBI requirements. As you know, in India, for a investor to invest in India, they have to go through the KYC procedures with SEBI and register. They may not be willing to do that. So there are, it certainly increases your large investor base in the US. And Gokul, I'll welcome you for your thoughts on London. I've heard that there are similarly situated, European investors who, would also prefer to invest in a London listed company, let's say, rather than a locally listed company.
Yeah, absolutely. Yes. Thank you for that, Rajiv. This goes back, in fact, to that incremental investor point, which is a lot of UK, European, and US investors certainly do invest in India. They've been doing that for over a decade, and that's a very large set that do that. But putting a story out on an international venue does put you in the investment parameters of an incremental shareholder base. And on the LSE market, for example, what is that shareholder base we're talking about? There is about a $500 billion AUM pool of demand that is mandated to invest in LSE, where LSE has to be one of the international venues for that stock. Now, that company doesn't have to be a UK business. What it's defined as, it has to be on the LSE. So that kind of goes back to your point around the incremental investor base. That you might get a further EM specialist who doesn't otherwise invest in India. You might get a sector specialist for the most part. You might get a UK specialist. That suddenly it opens up. And then lastly, of course, it opens up that passive demand I mentioned, because you'll go into kind of a FTSE series, and then all the ETF demand that hits you. Thank you.
Thanks, Gokul. Rajab, we've got some questions from the attendees, but before that, just wanted to check with you. Do you have any further questions for
Yeah,
our
Prashant.
panelists?
Yeah, I just want to take a couple from the panelists. I think, I guess, I just want to take a back step here, but taking a back step to see in the future. And if I may ask, whoever wants to comment, maybe with Bob to start with, let's say we fast forward next 10 years. We are sitting in 2020, very unusual year, lots of things going on, but 2030 from here, next 10 years down the line, India top 3 destination in the world for investors. We talked about a lot about transactions, global M&A, global private equity. Global private equity is already, we're in the top 3, top 4 in the world. But the next 10 years, next decade, if you want to build that out from an India perspective or from a global perspective, what are the top 2, 3 things, or maybe just one thing that you see a change happening in global capital market raising? And maybe if I could start with Bob, it'd be great to get quick top trend changing in the next 10 years.
Well, I think specific to India, I think that the dam is finally about to burst, and Indian companies are going to emerge on the more global stage rather than being confined to India. I think that secondarily, you'll see a trend of Indian companies, maybe a small number in the beginning, and then a growing number, but still small relative to the number of Indian companies going public in general. Back to my comment that most of the Indian companies and most companies belong in their local markets. I firmly believe that most of them will. So if we were blessed enough to get 20 or 25 listings to the US every year, and I'll let Gokul decide how many he wants. But I think that would be a very strong number. I mean, just think over a decade, you'd have 250 companies that came to the US from India versus what we have today over the past 20 years. And I think third, you will see this trend continue, especially among the large caps, especially to mega caps, of listing in another market, i.e. the US, and then doing a secondary, dual listing in the local market. And there will be more of the idea that was first articulated in the early 90s of the ability for capital to be, and these company shares to be traded globally within time zones. And so if you have a company that's listed on NASDAQ, and certainly US investors in their time zone will trade more actively during that period of time, and then Asian investors would trade if the stock was listed on NSE in Bombay. So I think that those are some of the trends that we would expect to see.
So 250 plus numbers, great. Frank, from your perspective, one top trend change that you see in the global capital market race?
Absolutely. And, I think I find myself very lucky, very fortunate to be in Asia at this time. Looking at my business, depository receipts, where we are seeing growth is, yes, we have tremendous clients in Latin America. We have tremendous clients across Europe. No one would argue all of the growth is coming from Asia. And that's exciting. And it's certainly, China, but it's Southeast Asia. And over the next 10 years, without question, it's going to be a big part of it is going to come from India as well, because we know once the regulations are in place where investors have more access to these companies, it's going to absolutely take off, because the demand, without question, is already there.
Thanks, Frank. Gokul, your quick comments.
Thank you, Roger. So I think, key trends, I was just writing this down here. So key trends over the next decade, I was going to break it down as what do we see as a global exchange group? You know, where are global exchange groups going? And then maybe where are capital raisings going? I think on the global exchange group level, I think you've already seen it. The global majors, the global top 3, top 4 exchanges are no longer exchanges. We're all market infrastructure operators, where the exchange is at the center and maybe it produces the new listings, but then there's a whole suite of services right around it, including information services, post-trade, technology, etc. And so where do we see global exchange groups going forward? I think there will be a greater focus on procuring and supplying the right data to the industry. It's around analytics. It's around selling subscriptions to the right indices and benchmarks. And broadly speaking, it's an information services business that we're all going towards. So that's on the global exchange group service level. On the capital raisings front, our view is there will be a lot more technology deployment in the raising of capital. Processes will be streamlined. There will be, and we're talking about a decade here, there will be a certain level of disintermediation of capital raisers, therefore, using technology to get over that and find that path to disintermediation. And finally, and I know that the US markets and the China markets already have a lot of this, but I think at the global level, I think we should see a lot more retail participation in new issuance activity. And over the last couple of decades, I think we've seen institutions crowd out retail in new issuance, as well as the monies in the exchanges and the monies deployed. I think you will see more retail participation going forward.
So more retail participation. Of course, one wish list I would have is cost of compliance significantly going down, so you can widen the market, the base, perhaps.
True. Yeah, I hear.
Bharat, quick comment. One top change next decade.
We sort of pull it back to India. I think that the time frame that you've taken, a decade, is fairly long. So I think that these Indian unicorns, the 30 plus, which I alluded to, are truly going to straddle the global marketplace. I'm sure more will be spawned along the way. And, in terms of fully integrating Indian capital markets with global capital markets, and this has been talked about for years, and if we just look into a crystal ball and gaze ahead, perhaps in 10 years' time, we could even hope for the rupee being convertible on the capital account, which would have, immense ramifications in terms of fungibility of market cap between domestically listed stocks and those which are internationally listed.
Thanks a lot. That's a great point on full capital convertibility. Back to you, Prashant, for the Q&A.
Thank you, Raja. I think time for some questions, and I had a couple of my own, so I'll probably try and club that. So everybody is aware that Indians like things which are a real good deal, and then they want perks as well. So my question for our two representatives from the major stock exchanges, Bob and Gokul. So question one, are valuations significantly different as compared to India on your respective exchanges? And let's assume that their valuations are significantly different. Then we want perks as well. So what support can Indian companies expect post listing in terms of hand-holding support? I mean, we're aware they're always have loads on the shoulders in terms of quarterly performances, vigilance from analysts, investors, all that. So what sort of support do exchanges offer, overseas exchanges offer to companies which list on them? So yeah, two questions there. One is how different is the valuation, and what is the post-listing support that's offered? Bob, can I request you to go first on that?
Sure. So I think every company is going to be different in terms of their valuation metrics, depending upon what vertical they're in. If they're in technology, they certainly would do very well in the U.S. markets. The technology PE ratios in the U.S. are some of the highest in the world, and we've got some of the fastest growing companies in the world, and they would be alongside and be thought of in that group. So I think that in terms of valuations, the U.S. remains I would argue the strongest market for valuations globally, especially in certain sectors like technology. When it comes to support, that's something, Prashant, we've really spent the past decade and a half focused on, which is not just how do we support a company from New Jersey going public, but how do we support a company from New Delhi going public? And it's really, for us, understanding the fact that companies have a new set of challenges as public companies, and they come into the investor relations, communications, and corporate governance areas. And that's where NASDAQ has built out businesses in those areas. And so we have this investor relations suite, the advisory suite that I spoke about earlier, that helps companies with things like stock surveillance, so understanding who your shareholders are, targeting, so spending time with the right shareholders, perception studies, how does the market view you, and what are the areas which you can improve in order to get a higher valuation in the market, as well as a platform that we have called NASDAQ IR Insight. So we have a whole suite of services, and the great thing is that some of the most regulatorily required ones, like producing investor relations websites for companies, we do that for the company during their IPO process, so they don't even have to worry about diverting their attention from themselves or any members of the management team during the most important time when they're really focused on getting ready for their roadshow and meeting these new investors. So I like to call it the IPO in a box. We really provide all these services and deliver them to companies. And then the other piece is that a company may be very well known in India, but they may not be very well known in the US. So it's how do we help them to market to a brand new set of shareholders? How do we open them up to a brand new set of customers? And then how do we increase their visibility in their local markets? And we work with companies directly on all those different areas, understanding their needs and goals, and then delivering our assets to help them achieve those.
Thank you, Bob. Gokul, anything that you'd like to add to that from an LSE perspective?
Yeah, sure, Prashant. Sure, I'll perhaps add to that in an abbreviated format, and then I wanted to pick up one of the questions that had come through in the Q&A on the chat channels. So I think I'd like to say that a lot of what Bob mentioned, is NASDAQ's let's call it issuer services platform or issuer services format to new companies. We do the same. We call it, in fact, the issuer services forum. We make available our digital properties to the issuer. We make available trading data. It also is a platform where we curate the marketplace for financial and corporate services for those companies to procure. And here we're talking about board advisors, governance, ESG advisors, database firms, IR firms, etc. So it's all centralized through the issuer services portal. Sure, there was a question I'd seen a little while ago come through. I think it was something to the effect of, and it's an important point, this point around small and medium enterprises that could be in the tech world or don't have to be in the tech world. And when will, are the markets open for such smaller companies to go public? And I'll say something slightly controversial first, which is that, the equity capital markets regime and the whole IPO and going public process at some points is very slow to change. And change does happen, but change happens episodically, and it takes a while. India is on the verge of a very large change. And I think all the attendees to this event will see that it's taken a long time to change. But when there is a change, we see companies coming forth. Now, I don't expect the small, medium enterprise in IT services looking to raise $25 million off of a $100 million market cap being the first, second, or third direct listing. But once some of these billion-dollar plus market cap IPOs have happened, and there have been successes, I think this end of the market, an AIM or Standard or NASDAQ, will open up for these companies. So they wouldn't lead with this, but I think that change is coming. And I think that change will benefit some of the smaller companies in India as well.
Perfect.
Thank you, Gokul. Indeed, and on that note, gentlemen, thank you so much for your expert comments today. I really enjoyed moderating all of you, and I'm sure it was a great experience for our attendees as well. With that, I'd like to call upon our CEO, Vishesh Chindyok, for his closing remarks. Vishesh?
Thanks, Prashant. I think I'll be very brief. I know we are beyond time. Amazing on a Friday evening. We still have more than 100 people interested in listening about the option of overseas listing even before overseas listings directly are possible out of India. So it just shows, what at least the audience believes is the potential. I just say here, if you, and I divide this into two parts. If you're a company that's considering an IPO in India, or a company that is already listed in India, is on one side. And the other side is if you're a company that can't list in India because you're too small, because you're in a sector that the market here doesn't understand, say mining, or some other similar sectors. That's what I would break this up into. If you're in the first bucket, which is considering a listing, you have to think, are you building a global business or are you building a domestic business? Many of the panelists touched on that. I think Keshav started with that right at the beginning. If you are somebody who's in the global supply chain, even if you're manufacturing, if you are wanting to compete in the global stage, you ought to consider the option of an overseas listing. Of course, if you can't list in India, you're an artificial intelligence, you're a startup, you're pre-revenue, there's still options to list overseas, whether through SPACs, whether on the growth markets, or indeed on some of the main markets. There isn't a one-size-fits-all, but it is a unique opportunity that'll open up the possibilities for you as this plays out, as the MCA comes out with the norms that fix some of the hurdles that stand today. And as we said, I think Bob said, we really ought to think, how can we get maybe 200 more companies from India to consider overseas listings over the coming years, one at a time. And really one at a time, I'd say the last thing there, if any of you would like a conversation one-on-one, I'm sure my colleagues, myself at Grant Thornton would be happy to have that conversation. And I'm sure many of the panelists here would also be willing to give their time to, for you to better assess your options and whether an overseas listing is something that should be of interest to you. And you ought to start thinking about it now versus waiting necessarily for that change in laws. My big thank you to everybody. First, the audience to join us. We will produce a capsule of this and share it with everybody, including some of the presentation material and otherwise that I shared. There will be subsequent sessions to follow on the how of overseas listings, particularly in the coming days. So a big thank you to the audience and of course our wonderful panel and our wonderful moderators for doing a terrific job to cover so much of this over the last couple of hours. The entire team at Grant Thornton that worked on putting this together. Thank you very much. Have a lovely evening.